Good morning, everyone. This is Audery Mortgage Pros 411 with Kevin Casey. And today we are joined by none other than Nadia Evangelou. She is the principal economist for NAR, and she is going to help us understand what to look forward to in 2026 in real estate and housing. So we're excited.
Perfect.
Welcome, Nadia.
Thank you, Audrey. It's such a pleasure. Thank you for having me.
Oh,
And
we
it's a
love having
great
you.
time.
Yes,
Yeah.
we love it. Just before we get rolling, just a reminder, because we always have more economic reports coming out in the week, and this week is no different. Wednesday, we have PPI, existing home sales and retail sales, all of which can move the market substantially. Thursday, we have initial jobless claims, which we do every week. And then Friday, we have industrial production and capacity utilization, which I don't even know what that means exactly. I mean, I can guess a little bit, but anyway. Um, Currently, the last time I looked this morning, it's been bumping around a little bit. The 10-year was at 4.16, which is hanging in there
Yeah.
based on all that's been going on. So that's something. So we had a little time where we didn't have economic reports, and then we were waiting for inflation data. And last month, when inflation data came out, it was a report that combined October and November. So although the inflation numbers were a little better, people really discounted it because they didn't think that the data was strong based on the fact that it wasn't all done as it normally is. So now we have December
Mhm.
CPI, Consumer Price Index, which was on the headline up 0.31 month over month and up 2.68% year over year. Core was up 0.24 month over month and up 2.6 year over year. So core is what we usually focus on, and it excludes food and energy. And so it seems like that inflation is continuing to improve, Nadia, and get a little better. And we'll see again tomorrow with PPI. But what are your thoughts on this?
Sure. So it's relatively flat. This is what we see from the preview. So almost like unchanged. And this is an important, I will say, signal. So that's a good sign. So even though at first glance it might sound like uneventful and higher than the 2% that we want. So what it tells us is that inflation is not re-accelerating. It's not moving like sharply higher, and it's not surprising the market. I will say it's surprising because it's like lower than the expectation. So that was good that we had like today. So that kind of consistency, I will say, is exactly what mortgage rates like to see. So mortgage rates tend to respond more to unexpected like changes in inflation than to inflation simply like holding like steady. And that was one of the reasons I think the Treasury, 10-year Treasury is like relatively like low, close to 4%. So from a housing like perspective, stable inflation helps in a few like key ways. So first, it reduces like upward pressure like on interest rates. So when inflation is steady and gradually cooling, so there is less like reason for policymakers or the markets to price in higher rates. So that's one reason we have seen like mortgage rates drift lower, close to 6%, very close to 6%, and some of the days like lower, some of the data lower than 6%, which is great as well. Instead of like bouncing like around as much as they did like before. So second, what we another like sign is that steady inflation helps buyers with buyer budget certainty. So when inflation is jumping around, households can better plan their expenses. So not just like housing, but groceries or like insurance or childcare or transportation, other like big expenses that they have like in their month. So that makes taking on a mortgage like feel less risky. So it's also worth noting that, okay, of course, like 2.7 is still above the long-term like target. Housing doesn't need, I will say, housing doesn't need to have like inflation to be perfect to improve. So what it needs is direction and stability. And we see that stability we'll see now. And so the takeaway, I will say, for buyers and lenders is that this kind of inflation reading like supports the idea of more stable rate like environment, not a return to volatility so far from the figures that we have. And the today reading, I think it was better than what we expected.
Right.
Yeah, so
Exactly.
my
Yeah.
my thing,
Go
I was
ahead.
my observation with inflation, like right now at 2.7, historically that's a great number. Like when
Mhm.
things are in that range, we tend to be better. And we've been in this range more often than we've been in the Fed's goal of 2% or below. And so it's like, okay, it's not perfect, but it's actually in some ways almost perfect.
Yeah.
Well, so first of all, we're at 2.6, not 2.7, which
Oh, sorry.
I
Yes.
mean, not to
Yeah,
be a stickler,
depends which one we
but
use.
it
Yeah.
does matter. So anyway, that's core. And then also, I have heard Scott Bessent say that they may be looking to reevaluate whether 2% should be the target and if that's reasonable. And to Kevin's point, I mean, that's a good point because we're not typically at 2% exactly. And maybe there should be, and his suggestion is a range. We should be aiming for this range, which I think, I don't know. You tell us, Nadia, is that more reasonable than trying to hit one specific number? Is trying to hit a range?
Indeed. And sometimes there were some arguments that maybe the 2% average is very low. So what we have should be like closer to 2.5, for example. So again, it's like the average for a period. So if it's like a little bit higher, a little bit like lower. So again, it gives like, we have like a range that range can support like to have like better economic like, conditions like and more favorable like conditions like for buyers as well there.
Right. So I don't know, hang on, kiddies, because tomorrow we have PPI and we hope that, again, we're hoping not for huge changes, but just for steady. And this is what the Fed's been looking at as well, they've indicated, which is they know we're not at 2%, but they're comfortable with the trajectory of inflation, which has been trending down over a long period of time. And it's just like everything where it's not a direct line. It's going to be, it's like this. I tell my client, I'm like, my clients are like, oh, what are the rates? I'm like, well, like this, they're up one day, they're down 2 days, they're up 2 more days, then they're down one day, like but what is the trend line? That's what we're really looking for, right?
Yes, and we need like when you take a look every day, of course you're going to see some volatility, but what is like it's like there is a steady and a stability that what we want to have from the market right now. So the stability will bring like more buyers as well in the market because stability can help you to plan your future and to make like better decisions. So I think that sometimes the number it's not that what it's like the most important thing, but it's more like the stability about planning the future, of course.
Yes.
Yeah.
Yeah. So what are the trends? That's, and again, the market gets so focused on, oh, today we got this report.
Yeah.
See what is coming, what is the trend? So interesting because last week was jobs week, which, weirdly happens every 4 weeks. It always comes as a surprise though, like, oh God, here it is again. So we got all sorts of numbers. So we got ADP that came in at 41,000 jobs versus the 50,000 job creations they were expecting. We had JOLTS, and that was for December. JOLTS was for November, and those are job openings and labor turnover. That's what JOLTS stands for. I always have to remind myself. So just a reminder, in 2022, we had 12 million job openings, and now we're at 7.15 million job openings. And there has been a lot of conversation around the idea that there are probably a lot of double listings of the same job in different states, different job descriptions for the same job. So whether or not that 7.15 million is real is debatable, but the previous months have been revised down, and other than COVID, the hiring rate is the lowest since 2011. So then, just for fun, we got the BLS jobs report, always our favorite. Although now that we have met with Ron Hetrick, who used to run the division that produces this report, we have a much better understanding than we used to. So seasonally adjusted, the jobs report for December from BLS came in at 50,000 job creations versus the 73,000 they were expecting. Health care and social assistance and leisure and hospitality were the front runners as far as job creations go, but the revisions were huge for November and October. So November was originally up 64,000 jobs. Now it's up 56,000 jobs, but we have one more revision to go. October had shown 105,000 job losses. Now they're at 173,000 job losses. Interestingly, the unemployment rate went down to 4.4% from 4.6. So, for perspective, last January, the unemployment rate was 4% versus the 4.4 where it is now. So jobs are not as strong, but
Yeah.
if inflation is getting better, but jobs aren't as good, then it helps the Fed because at least they don't have conflicting things going on within their dual mandate, right? So, and I'm realizing that when I write unemployment, I always write UW, and that's underwriting because that's like so in my head. But anyway, I have to anyway, that's beside the point. So here we are with these jobs report, Nadia. What do we do with this?
So yes, what we see from the latest reports that we are adding about like 50,000 like jobs per month, and I will say if you remember back in like in September that we revised about like how it was like performing in 2024, like previous year, we had like that average about 50,000 jobs. So, but we thought that we had like much more like back then, like in before September. So we have the same that we had like last year. So it's like slower. We see that it's slower. It's not a sudden slowdown or a new shock, I will say. So it's more of a return to normal hiring pace. So we had the pandemic, then we had the pandemic. During the pandemic, we're trying to add the jobs that we lost, and then now we are after the pandemic, like all this shock, and we are seeing slower, of course, like employment, but more, I will say, like something steady. So if we continue to add jobs, that's a good sign. So the next readings are very important, I think. We still like add, it's 50,000. It's not something, but it shows that hiring isn't running so hot. It pushes like inflation back up or forces like interest rate like higher again. So that's good because, of course, employment has a relationship, of course, with rates and inflation, as you mentioned. So it's not still not alarming to me, and not alarming yet for the housing market in order to affect the housing market in 2026. We don't expect that. So we expect it's going to be steady. We see that it's like slower, but this also gives some room for the interest rates or like, and then consequently the mortgage rates to trend down and to be like lower, that we expect to have around like 6% or like lower than the 6%.
So we used to expect that we are going to have 200,000 plus
Yeah.
job creations a month, and now we're at 50, but that's still comfortable because why?
We're adding jobs.
Because it's positive. So the fact that we're
It
not
is
200 versus 50 is okay.
It's slowing. That's something that's one of the signs that we need to monitor the next like months how it goes. Of course, we know like everything, like especially like in DC metro area, is the impact is stronger here. So unemployment rate is much higher. We haven't returned to the jobs that we had back in the pre-pandemic. So it depends on the area. Like here in the DC metro area, especially, people can feel it more. But as national level, yes, it's like slowing down. It's affecting people, of course. I'm like about, again, planning the future, because when they don't feel certain about the future, about employment, that can affect their housing like decisions as well. But it's not one of the factors that we think that it's going to slow down housing market next year. There
Okay.
are other factors that they will help with more buyers to be back to the market. So like lower rates, stabilize like rates close to 6%. We expect to bring like buyers. So this slowdown that we see in the job market, of course, is like a slowdown, of course, affects some people like in their decisions, but we don't think that it's going to slow down the home sales, for example, in 2026.
Great. Wow. That's great. I mean, to put it mildly, that's great. Okay, so Realtor.com came out with their active inventory numbers for December. We're under 1 million units, but up 12% year over year. According to Realtor.com, everyone has their own metric for this somehow. But we're still 5.5% under 2019 inventory levels at a national level.
Yes.
So I mean, again, the idea that we have this glut of inventory is a little crazy, because that certainly isn't what we're seeing. I'm not seeing it. Kevin, are you seeing a glut of inventory?
No, No, there's some inventory, and then
Yeah.
there's not a whole lot of buyers for it. It's just like very even.
It depends, Kevin, because there are some properties where there will be, I'm not
Yeah,
joking.
yeah, yeah, yeah.
I've
Some
seen
properties
14
go like crazy, and
Yes,
some
14
sit.
offers. There, I mean, the
Yeah.
buyers are there. It's a function of I mean, honestly, okay,
Mhm.
cover your ears, Nadia. So, are the realtors doing their job? Do you have really good realtors on both sides? It's so critically important. And then you must, and I mean must, add a really professional, good mortgage person in the middle of that once
Mhm.
you're in contract. That is what is getting these deals closed.
And it's the property. So, like for instance, one of the things that's really big with properties right now is not the condition, is not the neighborhood, it's the layout of the property. And that's what I'm recently learning is that if the property has the layout that everybody wants, it's going to be hot, almost no matter the status of the property. But if it's like, what's not hot, and let's say it's like the bathroom is not in a master bedroom or whatever the hot demand is, that property just sits. So that's what I'm hearing from realtors, that it's really about how the layout of the property is one of the most important things.
Okay, let's just say that the master bathroom being in
Mhm.
the master bedroom or sorry, primary bedroom having a bathroom is not a hot or, it's a
Well,
necessity.
so this
Necessity.
this this came up when I learned about this when I was reading an article about people fixing and flipping houses. And apparently, it is the number one thing they look for other than how much is doing the math, how much will it cost to fix this place up to make it sellable? But they will not touch a place that doesn't have the layout that's the hot layout.
Yeah, that makes sense. I mean, it absolutely makes sense because there are certain things, and especially in certain areas, like where I am, you better have done something to the property. The condition really matters. And by the way, you better spend 10 grand on staging. I mean, that's
Mhm.
kind of a basic minimum
Hmm.
around here. So I know it's different across the country in different places. I've had people say, what? They do what? Why would you need to do that? I mean, here, like, move out. Like, literally, don't be living there. Stage the property, and that's what will make it sell. So many realtors will tell you that. So it varies from area to area, but I think,
Hmm.
yeah, I mean, obviously, you need a bathroom in the primary. Look at that, twice in a row.
That reminds me of a Candid Camera episode where they took a house that was for sale and they made it look like there was no bathroom in the house. They closed off the wall where the bathroom was, and they just were waiting for people to figure out that there was no bathroom in this house. And it was hilarious.
Oh my God. Okay, so first of all, you are really dating yourself with a candid camera reference. Second of all, the fact that Kevin's even awake right now is remarkable because the last time you saw him last Tuesday, he was in the USA. And today he's in the USA. But in between, he went to Australia and back. That's right, Australia. That would
Yeah,
be a 16-hour
for
plane ride
5 days.
and a 19-hour difference in time. So anyway, how
So
about
Audrey, if I do fall asleep during the thing, just let me sleep, okay?
actually, I would, well, okay, I'm going to just leave that one alone because there's so many things. So we have a bunch of comments in the chat. So one is in the inventory where we need it, location, price range, etc. Um, the focus on lowering interest rates is misguided. I totally agree. We need incentives to builders to build affordable, aka in the price ranges that can be afforded.
Yeah.
Well, okay, you can't do that when lumber costs $1 zillion and labor costs have gone through the roof, and you've also, gotten rid of a big chunk of your construction workforce. And how are you going to cater to the price range when the actual cost of construction are so high? Nadia, do you have thoughts on that?
Sure. So can I add a little bit? Like, so the issue is that we are adding
Thanks.
inventory. So we see this inventory coming to the market, but the thing is that it's not everywhere. It's not evenly, and especially when we take a look at the price ranges. So we're still because I have heard like many headlines. There are like more sellers than buyers out there, but I'm like, no, the inventory is still limited, especially when you take a look at where people can afford to buy. So we have like if your income about $75,000, you can afford to buy only 21%. And then the median income, household income is like 81. So very close to the median income. We see that they can afford to buy less than 1 in 4 listings out there. So this can also explain why some of the homes that they go out, that they have like still multiple offers, depending on the location, of course, because they're still like a very limited, especially where exactly like people can afford to buy and the local incomes can support. So I think that's the main, and we know that issue. Of course, the construction cost is one of the reasons that we see that home builders, it's not that they don't want to build less expensive like homes, but they cannot do it because of the prices of the construction labor cost as well. So everything is like, and it's getting like more expensive. So when we talk about inflation, sometimes we're like, okay, inflation is lower, but that doesn't mean that prices don't increase. So they continue to increase, but it's about the pace. So that's limited. Like from them, they have the limitation. They cannot. It's difficult for them to build homes at the price ranges. We are missing about 1 million homes with a price less than $260,000. So yeah, that's the national figure that we have. So that's a lot, and of course it's difficult. It's very challenging, but we need to have like more inventory at where people can afford to buy.
260?
260. So it's difficult.
I didn't understand. You got to say that a couple more times. What?
Yeah. So 1 million listings we are missing in the price range less than $260,000. The good thing is that what builders do is that they're building smaller homes that they used to do like in the recent years. So that's the way that they decrease a little bit like their the price, and that's the reason that in the summer we had like the new home sale, the median home sales like price was of the new homes was lower than the existing homes, the median price for the existing homes, because they're able to adjust in the preferences that of the buyers. Unfortunately, with existing homes, you cannot decrease the price from the point of view that you cannot change the size of the home. It's the existing home, so unfortunately, you cannot adjust so directly like to the preferences, the buyer's preference. So the builders are responding from that point of view. We see a declining, like smaller sizes of homes that can also help to decrease relatively to have like more reasonable like price of the homes.
That makes total sense, actually. I've read that too about them. I saw this chart about the size of homes over the last, I don't know, 50 years or 60 years, and it definitely has undergone a a change. They got bigger, bigger, bigger. I mean, I know that where I am about, I don't know how far it is, honestly. Anyway, it's not that far, but it's not that close. They were building big time out there for years and years and years, big subdivisions, and we called them sheetrock mansions because they were building these large houses on these tiny little postage stamp lots, but the quality of construction was just crap. So you would buy one of these and you could show your friends, look at this big house I have, but it wasn't great. And, God help you when your PG&E bill came in during the summer and it was hotter than Hades out there and you were boiling to death in your upstairs. And anyway, Kevin, you're
I know someone who lives in a similar area, and they did the stucco with the styrofoam behind it around the windows, and because it looks good, but it's just styrofoam, right? But it was on a golf course, and their whole wall had golf balls that were embedded into the wall because it would hit the stucco and just be stuck into the wall. It was hilarious.
Are you kidding?
No.
That's fantastic and ridiculous all at the same time, of course.
Yeah, it was faster and simpler. Just put styrofoam up, throw some stucco on it. Bingo, bango, house is done, right? Insulated, closed up, sealed. Oh, but yeah, hit it with a golf ball, it'll stick right into it.
That is amazing. Okay, so we have a bunch of comments. So Ed says, so talk to those agents about reno loans, the ones who are, where the property's not updated. And then Jenny says, in my area, many of the younger buyers want a home that's been updated recently. If it's bougie, it sells quickly. And if you need to define bougie, yeah, go back to a few of our other episodes where someone made that comment to me. Anyway, bottom line is it depends on your area. It depends on the demographic. A lot of people are very intimidated, don't want to have anything to do with renovations. I mean, me, I would not buy a house that was done. I would never buy a new house. I want to go in and take some total, uh, okay, well, the word that's in my house is in my
It's
head,
fixer is what you were,
mildly
but I think you,
inappropriate. I want to take some crappy place and I want to turn it into something gorgeous. That's what I want to do. But I want to do it, but not
yeah.
everybody does, right? Um,
Well, locally they were talking about this down in Silicon Valley, and they were saying how you can't find a small house anymore because pretty much everyone's bought up all the small little houses, torn them down, and built, McMansions on them. And when I was in Australia, the trend was the same thing. It was every block of a neighborhood I drove through, there was someone tearing down a house and building a new house. And it was quite extraordinary.
It doesn't it look, I always, when I drive through neighborhoods and I see, okay, here's this cute bungalow, cute bungalow, cute bungalow, and then boof, there's
Yeah.
that that house.
And it's the same architecture
Hopefully,
everywhere in the world. It's that concrete glass architecture that's like you have these beautiful, either brick homes or wooden, like Victorians, and then all of a sudden glass concrete construction. Like, what's up with this?
so there is also the comments that adding all the new requirements in to build a new place adds to the cost, like fire sprinklers, which is good. I
Mhm.
think. But but also I think in a lot of ways some of the requirements are over the top and add a lot of extra cost. And that goes with renovations too. Like the description, I haven't done a renovation in a while, but the descriptions of the dealings people have with the city inspectors, etc., are ridiculous. I mean, you're dealing with cranky personalities sometimes, people who just it's not good. And it makes it so there it adds this layer of sludge to the whole process that increases the cost exponentially. And it's we I think there's sometimes there is this idea of here, this would be perfect, but perfect is expensive and it's relative. So my perfect is not your perfect, which is not your perfect. And, as I'm driving through Europe or the UK and I'm seeing places or staying in them that have been there for over 1,000 years and everyone's fine. And there were no, like I think we need to moderate this idea that it all has to be perfect and totally regulated. And, there's got to be some happy medium in there. What do you think, Nadia?
Yeah, comparing to Europe, for example, yeah, we have significantly less space in the home. Yeah, so there are like apartments. Most of them they don't have single family homes like in Greece. Originally, no, like the standard is to live like in an apartment, for example. So usually your kids are they share the same room. Here we have more bathrooms than bedrooms, for example. So that's in the beginning when I first moved here, I'm like, wow, how can you have more bathrooms than bedrooms? But
Yeah.
if you ask me now, I like it.
Let me say that if I were in Greece and I was not living in a little place on the water by myself, I'd be so disappointed. I don't want to go to Greece and live in an apartment. What the heck? Is that not
Yeah.
move to the
In,
US, Nadia?
but I'm like, if you are in Athens, it's very congested like that area. But otherwise, yeah, when you go to a smaller, like, or an island, no, it's not like apartments. This is like where you can find like houses, single family homes there. Yeah.
Okay, so just note it that if I move to Greece, I'm moving to an island so I can be in a little house. So Peter says that in the 1940s, the average was 2 to 3 bedrooms and average occupants 3.6 to 3.7. Peter must know that I love numbers and statistics. The assumption that every kid gets his own room and the parents have a room for a home office or a craft room is new and valid, by the way, if you ask me. So anyway, it's somebody else said that their client just bought a 1,250 square foot rehabbed ranch in San Jose and it cost 1.25 million, but it was small. And so again, for San Jose, 1.25 million is not terrible. I mean, that sounds in
No, that's pretty cheap.
Yeah.
That must
oh,
have been a rough neighborhood.
I think like, water shutoff valves, that's a great thing to put in every single property. So if there is some sort of water leak, you don't have a huge flood and it doesn't destroy your.
Yeah, and that's not that expensive, but sometimes then they get really extraordinary. They want smokers, sprinklers in the houses. And that's expensive if you have to retrofit or add that into your construction costs, adding sprinklers throughout the entire house.
Well,
Um,
too, I think at that point, yes, ideally, maybe that's great, but does it make sense? And how often is that an issue? And how, I don't know. I don't know the
yeah,
answer.
and then the problem is then someone breaks one of those sprinkler heads because they're stupid enough to hang a coat hanger on it, like I experienced, uh, and they fill the house up with, thousands of gallons of water. Yeah, you wait for the insurance on that one.
They'll cancel your insurance these days on that one. Okay, so Peter is saying Long Beach, the 3-bedroom, 1-bathroom built in 1930 is only 640,000. Although one bathroom, see, one bathroom is a deal for me.
It is.
Okay, so we've got better inventory, but not crazy. Housing starts and permits, by the way, you were talking about building, Nadia, and they came out with October's report last week, and permits were down 0.2 month over month. They were at 1.41 million annual units and down 1.1% year over year. So permits were pretty flat. Starts were down 4.6 month over month month over month, 1.25 million annual units and down 7.8% year over year. Completions were up 1.1% month over month at 1.39 million annual units, but down 15.3% year over year. So again, it's going to be very area specific to your point. And I mean, there are some areas like there's just where I live, there are no subdivisions going in because there's no space. They have built some buildings higher, they have built some apartments or condos, but they're really expensive. So, they're certainly not satisfying some affordable housing itch that someone might have. These are places where you're paying rents of between $4 and $6 and $10,000 a month to live in a 2-bedroom place in a downtown little, like my town is little. So I just find the whole thing very interesting. Okay, so there's a couple things I really want to get to, but I briefly wanted to mention because we've heard so much about the CFPB. They have cut the staff down to next to nothing, and they were basically going to just wait till it ran out of money. And then they didn't want to get more money because they said that blah, 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 right? Okay, so apparently a US district court said, nuh-uh, that is not okay. So the CFPB has requested $145 million from the Federal Reserve to keep the CFPB going. So the litigation has not ended by any stretch. And I don't know how they're going to spend that 145 million considering
Well, they only have what, 7 staff employees now?
200 was the last we heard, but yeah, it's probably not far from 7. Although I've got a deal right now that I wish to God we had a really, really strong CFPB because I don't think there are enough regulatory agencies to to report this whole deal to and these people like we need to have a place with teeth in it so that if somebody is doing something to borrowers, there is some sort of recourse and someone's afraid of something. But anyway, that's a whole nother issue, I guess. Okay, so there is been a plan floated to buy 200 billion in mortgage-backed securities for Fannie and Freddie to buy $200 billion in mortgage-backed securities. The question is, can they? And we don't know the answer to that yet. I've seen a lot of different conversations about how they don't have that kind of money and it's not possible. But if it was, what would that do to the market? Nadia, how would that help?
Sure. So when we talk about MBS, like mortgage-backed securities, like support, it's important to remember the context. So over the past decade, like the Federal Reserve purchased like trillions of dollars in mortgage-backed securities, which played a major, I will say, role in keeping like mortgages relatively like low and stable. So over the last few years, as the Fed pulled back from those purchases, we saw like mortgage rates drift higher, not just because of inflation, but because the market lost like a large, consistent like buyer of mortgages. So without some form of backstop or like a large buyer in the market, mortgage rates like tend to reflect more volatility and higher risk premiums. So that's part what we have experienced like recently. And the whole plan, I think, is like to address that dynamic. So by reducing like the support, it can help like lower mortgage rates at the margin, and just as importantly, like, improve liquidity and confidence like in the mortgage market. So this is what we should have, like, I think in mind, like MBS, like, is that it's a tool that can help stabilize and modestly like lower mortgage rates, support like home buyers, of course, consequently, and improve like market like functioning. So that's the ultimate like goal of having this support like with mortgage-backed securities.
Yeah, well, yeah, so we'll see what happens with that. I mean, only time will tell, right? I saw another post where a billionaire hedge fund manager, Bill Ackman, has called for Fannie and Freddie to offer new government-backed mortgages with prepays. And the idea that we have some lenders who are set up to just churn borrowers. And so every time the rates go down a quarter, let's refinance you and we make money. You, on the other hand, as the consumer, you now owe longer on your mortgage. I mean, there's so much hair on this. So to do a refinance to improve somebody's rate position, I think that there should be a tangible longer term payoff for them as they're paying closing costs. And it's hard to do. Like, it's like those no cost loans are, I don't even know if you can do them anymore. I mean, the rebates just, I don't know if they're big enough. So
The banks do them all the time.
Well, of course.
And they don't even have an early payoff period. They can do it, close a loan this month and do another one next month. And sometimes they do it where, okay, we'll include your property taxes in the thing so you don't have to pay your property tax this month. That way, and we can lower your interest rate. Oh, but they don't go into the fact, yeah, but you're going to be paying another 7 months on to your loan. And I remember doing that with a client one time with it. Oh, yeah, see, I can drop my payment by, $50 or $75. And I'm like, yeah, but you're losing it on the backside. You're going to pay, another 15,000, 200,000, whatever the number was, on the backside. Why would you do that,
Right.
today?
Right. Well, this guy is saying that and I think he's talking about a prepay for the life of the loan, which I'm not a fan of. I don't think is a good idea. But he's saying if you did do that, their calculation is you could save 65 basis points on the rates, which would reduce the rates at this point to, low fives, right?
Mm-hmm.
But again, I think that you have to give people a flexibility around getting out of their mortgage so that if they need to move, if they need to, if the rates do drop a percent or whatever, they are able to refinance without a horrible consequences on that end. So I don't know. For me, again, I really sort of tread in the middle, I realize. So for me, I don't want a forever prepay, but I don't want no prepay. I would like some prepay, and that would get rid of our EPO problem, which only the LOs bear. So there you go. I just thought it was interesting because I hadn't seen that until, well, just now. So recently. So it's interesting that it's being floated as another idea. Another thought that's being bandied about is a ban. President Trump proposed a ban on institutional investors. So nationally, it's only 1 to 3% of the market, but some markets have a lot more. So Nadia, tell us about that and how that impact could be an improvement in some areas.
Sure. So when we have like corporations, companies, and LLCs, then the share goes around like 60%, 15.7%. But again, they say that's a small. But what I will say that the national like average heights, what's happening like on the ground. So the data shows that homes purchased by institutional buyers are priced about 30% below the median home sales price. So which places their activity very close to what like the entry level and the lower middle segments. So these are the same, like I will say, price tiers where first-time buyers are most like active and where inventory is already extremely like limited, as we mentioned like before. So that's why this issue like matters so much like for affordability. So even a relative like a smaller, I will say like share of buyers if it's like in one area, but again, can have an outsized like impact when they're like concentrated in the most constrained like part of the market. So in many cases, institutional buyers who can pay like all cash as well are competing directly with first-time buyers, often like cash offers, or they can offer like faster like closing, which tilts the playing I would say, like field. So we also see where these institutional buyers are localized. There are like certain states and metros. So like places like Rhode Island, Connecticut, Georgia, New York, and parts of the Sun Belt. So Texas as well. So they have much higher concentrations of corporate like activity, and often in already supply constrained like markets. So in those areas, the pressure on entry level like homes, so it's really is very real. So that's the concern, and this is how the ultimate like goal is to help like more first-time buyers not to have to compete with corporations and companies that are able to pay cash, for example, and like the inventory that it's already limited out there.
That trend started back in 2008, 2010, when all these developers who got caught and with building these homes and they weren't quite finished. And so what they ended up doing is they reached out to the BlackRocks and said, hey, we'll finish them, we'll sell them to you at a discount, but at least we get our money back. We're not going to lose our business, and the company's not going to go bankrupt. And it's kind of a win-win-win. And it was a win-win-win because they were able, these companies came in and they provided housing to people because they finished construction. The data they received on so like these BlackRock guys, they know exactly when to repair and when to replace what part of the house. Like, okay, at this point we need to remodel the bathroom, at this point we need to remodel the kitchen, at this point we need to upgrade the air conditioning, this kind of stuff. They have it down to a science as to what makes the most money, what's going to return the most money. So a lot of data was gained from that, but it's at the same time, I could see where you don't want these companies holding these properties forever.
That's a good reminder, Kevin, of how it all began, because I had totally spaced all that. But to the point, I think it is great. I mean, banning institutional investors, I'm totally fine with. I wouldn't loop in every LLC because I have mom and pop investors who have a couple of properties and LLC, and they're great landlords. They're good to their buyers, and they're certainly not impacting markets in the way that an institutional investor would. And at some point, we need some rental properties. So we want some people to have single family rental properties as an option to rent. So anyway, so I think again, there's some middle ground in there. I would totally support a ban on the big guys as long as we leave the little guys alone, because God knows it's hard enough as it is for them. What do you think?
Me, yes, I totally agree. Yes, that large institutional buyers, indeed, like getting like the houses that first-time buyers can have the option to have and compete like for these homes, it's not fair to them. I'm like, that's I would say. And sometimes we're thinking about how many homes they buy, but it's about what kind of homes they buy. I think the meaning of the whole like all this effort to help like first-time buyers to compete like fair with other first-time buyers, for example, not the big companies over there.
Yep. Yeah, it is. It's the industry and all these ideas that are being floated. So, some of them are, they have some, they're, what's the word I'm looking for? It's good. How about that? Okay. So NAR came out with their projections for 2026, which we've talked about pretty at length here, but I want to go through it again. And I'd like to hear from your perspective. You were part of all this and you're very familiar with all this. So tell us how you got there. So home sales up 14% in 2026, 6% mortgage rates, which we're seeing all over the place. Like that's kind of the expectation, and appreciation at 4%, which is awesome. So tell us about that and how you guys think that is our market going forward.
Sure. So that outlook is really driven by the two things that we think that will matter like directly to the market this year. So first of all, mortgage rates. So we expect mortgage rates with a couple of additional like rate cuts from the Fed to happen like throughout the year, and already mortgage rates close to 6%. We expect to be around like 6%. So to average 6% in 2026. So and what we see is that even small declines can help buyers re-enter the market. So it's not about getting back to historic lows. We don't expect that. And it's not neither like going back to the 4% or 5%. So we expect something like around 6%, I mentioned. So it's reinforcing mostly confidence and affordability at the margin. And then the second factor the thing that matters this year is like inventory. So we are finally seeing more homes come to the market, not everywhere, not evenly, as I mentioned, but enough to give buyers more choices and sellers better clarity on pricing. So and in fact, when mortgage rates ease and inventory improves at the same time, so this is when we see the transactions to start to unlock. So, and that's the foundation of our forecast for 2026. And specifically, we estimated that with rates from 7% that we had like recently, like during the summer, going down to 6%. So this will allow about 5.5 million more households to be able to afford again the median priced home. So of course, not all of them buy a home. So we estimate about like 10% of the qualified households usually buy a home. So we speak about 500,000 like more listings in the next 12 to more home sales in the next 12 to 18 months that can also support like the idea of like 14% like more home sales in 2026. Then with the price increases, what we expect is about like 4% healthy level. We have like more inventory. You have more buyers out there since they can qualify. So not there around 2%, but healthy price appreciation that we want to see. No double digit. It depends again the location, of course. What we say that, for example, in New York, Long Island, that they continue to have almost like double-digit price appreciation. So again, it depends on the area, but at the national level, we expect about 4% for this year, for 2026. So that's what we expect at the national level. But I know that you know better than anyone else that people don't buy homes in the national market. So they buy homes like in your neighborhoods, in your streets, in your community. So the real question is where buyers will feel improvement and where the opportunities will be. So having that in mind with the combination of the lower mortgage rates, and the better inventory to align with local incomes. We were able to take a look as well at other 10 forward-looking indicators, and specifically we looked at where millennials are concentrated. We look at income and job growth, then migration, where people continue to move. Then we have the two pillars of our forecast, as I mentioned, like how the market responds to lower mortgage rates, and then how well listings match local incomes. And then we also took a look at price cuts in the areas, compared like mortgage payments to rents and new construction and mortgage origination trends. All these 10 factors, they gave us like where we think that what markets are opening up in 2026. And we have, for example, Charleston, South Carolina, we have Charlotte, we have Columbus in Ohio, Indianapolis, Jacksonville, Minneapolis, Raleigh, then Richmond, Salt Lake City, and Spokane. So we have these areas. These are not simply cheap areas. I will say it's not that it's going to be, you're going to find like the most affordable. Some of them, they have like a very steady, like affordable like path over there. For example, Indianapolis, but some of them, they will have, we expect they're going to have opportunities in their area, like in 2026, as they have like more inventory that can align better with the local income. So that's the foundation of our forecast for 2026, and specifically some of the areas that we expect to have like to outperform compared to the national like forecast that we have.
Wow, there is a very high match for humidity with most of the population, isn't there? Because I'm like, okay, I'm listening to the list and I'm thinking Spokane, Salt Lake City. Those are the only two places without tons of humidity, right? So, anyway.
We have Richmond as well. Yeah.
Richmond, they don't have humidity in Richmond?
Okay.
I don't know. Anyway, it's my brain occasionally goes off in a direction.
Oh, yeah. I've never been to Salt Lake City. I have to go.
I've been a few times. Oh, somebody said Richmond is humid. So we've been a few times, and yeah, it's it's too far from the beach for me, but whatever.
Yeah.
All that. The point is, there are places where it is affordable to buy houses in the country, should you wish to move there, work there, live there. So that's good and it's promising. And I also liked seeing, I saw some list about, every time I see a list where it's saying the worst, the best, I'm always happy when California is not on it because I don't want to be on the extremes. I want to be something that's more reasonable and it's not making the top, 10 list because yeah, for a myriad of reasons. All right. So,
But okay, yeah, San Francisco, for example, is making like big progress. This is what we see. So we see improvements, but and we see like more inventory to align with the income. So that's a big step for San Francisco, for example. But it's not one of the areas that we expect that will outperform. So again, we have like every year we identify the areas that we expect to outperform the national average. So the forecast. So
right. Um, yeah, I would like to buy rental property in those areas, not in an LLC apparently, so I don't get banned at this point, but yeah. Okay, so another thing that I wanted to talk to you about was this call for a huge price adjustment. So I've seen on LinkedIn so many people who are in the mortgage space and who I think should know better, but whatever. I'm going to hear what you have to say. And maybe I'm totally off base on this, but I can't see how having a big, huge price decline is going to serve anybody really, except for the people who don't own anything right this second. But for the person who does own a property, or God help him, has bought in the last 3 years, or I just don't see it. And I'm so frustrated by all this talk. So tell me why I'm wrong, or maybe I'm not wrong.
no, my simple answer is like no, I don't agree that the huge like price decline can solve the issue. So you're absolutely right. So there is. I heard about that as well. Like there's a common like narrative out that the only way to fix affordability is for homes prices like to fall. And from an economist like perspective, have in mind that that's only part of the story and often not the healthiest part, I will say. So affordability improves through multiple channels, of course. So we have like three factors that that are mainly affect affordability. So we have mortgage rates, we have incomes and prices. So what ways can help with affordability? We can have like lower mortgage rates, rising incomes, as you mentioned, like lower prices, but then we can have like better inventory that can help as well. So you don't need prices to collapse for buyers to re-enter the market. And in fact, we run like an analysis, and what we see is that the effect of the 1% point decrease in the mortgage rates is the same in the affordability as a 10% decline in home prices. So that's huge. I think so that this is what we have to have in mind. And what we also see is that many of the markets are seeing like prices hold relatively like steady or grow like modestly. But buyers are qualifying again because their incomes are catching up, and the monthly payment like is finally working. So, and from a lending like standpoint, I would say that that's actually a much more sustainable environment when you have than one driven like by sharp price like declines. And then also think like for, as you mentioned, like for existing homeowners. So if home prices like fall, existing homeowner will not list their homes. They're going to sit there for longer. So you don't, you may increase affordability, but you don't increase the turnover rate. You don't increase like the existing homes available for sale. So the inventory is still like low. And what we want to have is like better affordability, but at the same time, more inventory. So more homes to be released to be available like in the market. And with the mortgage rates, you can do that. But with lower home prices, you cannot have that because people, they don't want to sell their house when home prices go down. So yeah.
Also, mortgage home values and interest rates are very similar in the fact that, Audery, what happens when we hit like 5 and 7/8? What do the real borrowers want? They want
Lower. It doesn't matter. Not a, I've been beating that drum for years because Some of us remember when rates were 2.25%, and we're quoting somebody. I mean, not that I have a specific scenario to relate to, but I'm talking to a financial advisor. He's buying a $2 million property. He wants an interest only loan and he only wants to put down 20%. And when I quoted him like two and a half or something like that, he literally said, I was really hoping for something lower. And I said to him, do you hear yourself? I mean, the
Yeah.
on,
So my correlation with that is that home values are the same thing. If home values start going down, people don't buy. They want it to go down further. And I can't tell you how many times I've had people like, oh, well, I'm waiting for the next market crash to buy something. And then after the market crash and I see them again, hey, did you buy something when the market crashed? Oh no, it went up before I thought it was going to keep going down. Like, no, you just are never going to buy. You're always looking for the excuse not to buy. It, People, when home values are going down, less people will buy. When home values are going up, there's a reason to buy because hey, values are going to keep going up, and they look optimistically, and like, wait, if I buy it, it'll be worth more, and it's going to be better. It's just a kind of how humans think.
well, and that's before we get to the other point, which is why in the world have we stopped thinking about what your family needs? Okay, does your family need to have 3 bedrooms instead of one? Or does your family need to live in a good school district? Does your family, right? Instead of trying to figure out exactly where the perfect moment is, and we know that interest rates and home values are not down at the same time, they're usually opposite. So
Hmm.
it just makes no sense. And I'm so frustrated. And thanks, Nadia, for letting us know that we're not insane to think a monster price correction is a stupid idea.
There are other ways, as I mentioned, and the effect, I'm like, it's larger. I'm like, oh, just 1 percentage point, like lower mortgage rates, and it's the same with 10%. It increases like 10% your purchasing power. So that's very, very uh, big impact, I will say. So from mortgages we can have. And what we have seen, for example, even though like home prices have increased because they continue to increase, even like lower, like about like 1%, what we see is that income growth and the easing mortgage rates offset like this price appreciation. So, and affordability is the best that we had like since 2023. So that's great, like the end of 2022. So yeah, so we have to have in mind that there are other like ways to do that.
Peter has a great quote. Everything seems cheap on the way down, everything seems expensive on the way up. That absolutely is correct. I agree
Hmm.
100%. And again, we're just going to go back to what Kevin and I talk about regularly is focus on purchases. When I started in this business 36 years ago, refinances were not a big thing. Purchases. And so if you focus your business on purchases, then you're focused on your borrower's needs, which is they need to live in a different place, they need to sell a property, buy a property. That's basic, right? Then the
Yep.
guys, which I love, no doubt, those are extra. And I think as a industry and the mortgage space in particular, we have become a slave to a refi boom. And I think it's unhealthy for everybody. It's unhealthy for borrowers as well, because there's this expectation that rates should always be lower, and we can't control the market. What can you control? You can control what you're focused on, which is helping buyers and borrowers do what they need to do in their lives, but not because your company needs to post quarterly earnings that are greater than last quarter or the quarter before, but because we're helping borrowers. And I would love to see us refocus on that. I don't know that it will happen, but I want it to, because the borrowers are what we should be thinking about. And that should be our whole purpose, is why are we here? To help borrowers buy, sell, have a life, build equity, have an asset, a stable price, for their housing that they don't have to worry about the rest of their lives. So anyway, that's my little wish for the world, but we'll see what happens. Kevin, you're still awake. I'm so impressed.
I am. I'm impressed. Didn't even nod off once there. You
You know,
know.
It's 7 a.m. tomorrow in Australia. So you're doing fine. I mean, it was time
Eh,
to get up anyway, so I'm glad you made it through. Good job. Oh my gosh. Okay, so everyone, thank you so much for all your comments. We love it when you're all chiming in and part of this with us. Nadia, thank you so much for being here. We love having you always. Such a little bright spot of information. Thank you.
Thank you so much. Thank you. It's such a pleasure to be with you. Yeah, thank you.
Yeah, exactly. So, all right, kids, have a great week. And I'm just going to continue to remind you that there is business out there. It's not easy. It takes a hell of a lot of effort. It takes your brain to be engaged because most of it is outside of the box, but it's there. So go get it. Make sure that you're getting up in the morning, taking a shower, putting on clothes that don't stretch, and closing some loans. So that's your mission for this week. We'll see you next week. Mwah. Bye.